What if I told you there is a secret code, a single number that can actually predict stock market crashes and make your credit card debt way more expensive? Well, it's called an interest rate, and today we're going to crack that code and see how this one little thing secretly controls your entire financial world. So why should you care about this? Simple. Because this one number quietly controls everything, from what your investments are worth to how much you're paying on your credit card bill. It's a huge deal that affects you way more than you probably think. Take a look at this. This is what can happen after a specific warning signal pops up in the economy. See, there's this thing called a yield curve inversion, and it has a crazy track record of predicting stock market drops. You can see right here, in the year or two after that signal, the market often goes negative. It's something big-time investors watch like a hawk.
Now, when you see a big drop like this, Wall Street has a name for it, a bear market. It's just a simple way of saying that stock prices are falling and, well, everyone's kind of pessimistic about the future.
But here's the thing, it's not just some problem for people on Wall Street. The exact same forces that trigger that warning signal also make the balance on your credit card more expensive to pay off every single month. So who's actually in charge of all this? Let's pull back the curtain and meet the main player in this whole story, the one group that basically controls the master switch for the entire economy. Okay, first things first, what even is an interest rate? It's super simple, I promise. Just think of it as the price you pay to borrow money. It's like a rental fee, but you're renting cash. So the higher the rate, the more expensive it is to borrow. And the organization pulling the levers on that price, that's the U.S. Central Bank, known as the Federal Reserve, or as pretty much everyone calls them, the Fed. They set the main interest rate that pretty much influences every other rate out there. And really, it all boils down to this one basic rule. When the Fed raises rates, borrowing money gets more expensive for everybody, from huge companies all the way down to you. And when they lower rates, borrowing gets cheaper. Let's see how that simple rule hits your wallet. All right, let's bring this down to something we can all understand. That little piece of plastic in your wallet. How does a decision the Fed makes in some big building end up costing you more money? It's a direct chain reaction. Check it out. First, the Fed changes its key interest rate. Then, the banks change their key rate, called the prime rate. And since most credit cards tie their rates directly to that prime rate, well, when the Fed raises its rate, your credit card rate goes up almost automatically. And just like that, any debt you're carrying gets more expensive. And believe me, that extra cost adds up fast. Just look at this. If you carry a $1,000 balance for a whole year, it could cost you almost $200 in interest alone. That's money that could have been, well, pretty much anything else. Okay, so we get it. It hits us in our own wallets. Now let's zoom back out and connect this to the really big stage, the stock market. You know, the relationship between interest rates and the stock market is complicated. It's kind of like that one unpredictable friend we all have. Sometimes they show up and it's a great time, and other times, not so much. Here's how that love-hate relationship works. When rates go up, it costs companies more to borrow money for things like building a new factory or creating a new product. That can slow down their growth, shrink their profits, and that makes investors unhappy. So they sell stocks and prices fall. But when rates go down, borrowing is cheap. Profits can grow, investors get happy, and they push stock prices up. Which brings us right back to that yield curve inversion warning signal we saw earlier. As you can see, on average, the year after this signal appears is not a pretty picture for investors. The market often drops right into that bear market territory we talked about with negative returns. So, after all of that, you're not on the outside looking in anymore. You've just learned one of the biggest, most fundamental secrets of the entire financial world. Because when you get right down to it, interest rates are the hidden force. They can speed up or slow down the entire economy, affecting everything from the biggest companies on Wall Street all the way down to your credit card bill. And there you have it. It's not some crazy, impossible code. Now you know the secret. You know the real reason why everyone on TV, from the news anchors to the top investors, totally obsesses over every single move the Fed makes. See, knowing how the game is played is the most important first step. Now that you understand the connection, how is it going to change the way you see the news? The next time you hear the Fed is changing rates, you'll know exactly what's going on. The next move is up to them. But now, you understand the rules.